Hey, Eric here from 5minuteinvesting.com, and my mission is to help people without financial background to master investing and get a higher return so then they can have more control over their financial destiny. So I came across your question on Quora on how to make money, or can you make money from randomly trading by using a good risk to reward approach. Now I actually think that is actually a very interesting question, and I'm just drafting my response for you right now. So I thought I might record a video response for you because it is actually better and easier to explain. So the first point is actually you need to understand the equation for risk and reward, or actually more accurately, the equation for profit. Because you can manipulate risk and reward all you want, whether that is 1-to-1, 2-to-1, 3-to-1. And I actually tested this using years of data. I don't have the data with me right now because I tested it over 5-6 years ago. And the short answer, I'm just going to save you some time, is no. You cannot just randomly trade, but using a risk to reward ratio and make a profit out of the market. And I'm going to explain why in this video. So the first point is the equation. And you need to understand the equation for profit. And I have laid out the equation for profit here, which is the dollar amount you win times the percentage you win, and the dollar amount you lose times the percentage you lose equals profit. Okay, whether that is net gain or net loss doesn't really matter, but that is the entire equation. So when you're investing in the market, all you're really manipulating is this equation. So I opened Excel here, and I'm just going to demonstrate to you what I mean, so then you get a good idea on how you can implement this for yourself as well. So let's say you're going to win $50, and then you're going to lose $50. Okay. So I don't know if you still remember this from high school math, but essentially, if you're flipping a coin and you have a 50% chance of winning, then you're gonna get this plus the loss times the loss percentage. So let me explain this formula. You have the win dollar times the win percentage plus a negative number, the amount you will lose, times the loss percentage. So this is the formula for your profit and when you're investing. So in this case, you're going to see that I completely break even, and I don't win anything if I play this game for a very, very long amount of time. So I break even here. So if you are randomly, trading with a good risk to reward ratio, or just even a 1-to-1 ratio, so risk to reward, all right? So this is 1-to-1. You're not going to get a gain. And this is the mathematical formula. And I'm going to talk about a couple more things that will stop you from making a gain and you actually incur a loss. But right now, I just need you to understand this formula. So the risk to reward ratio in this case is 1. So it's not a dollar sign here, it's actually just 1. So let's do another scenario. If you truly believe that the market is random, if you truly believe the market is random and the probability of it going up is the same as probability of it going down, then when you adjust the distance, which is the gain, it requires to go up, you also change the probability. Now here's what I mean. Imagine every time you play this game, you're going to win $100. And if you lose $50. Now, you suddenly have a net gain of 25, correct? But when you're looking at the market, right, the distance the stock needs to travel also increases. So then the probability that the stock will travel to $100 instead of a loss of 50, assuming it just kind of fluctuates like this, if you look at my mouse, is also changed. So instead, you're going to have something like 33 to 66. So in this case, you'll see that it completely break even again. So in this case, the risk to reward is different and is favorable, but then it doesn't necessarily help you. So in this case, it's 2 to 1. Again, I'm going to make this not a dollar sign. So, okay, now you understand. So that means if you have a different risk to reward ratio, what you need to first do is to calculate your break-even win percentage. And this is the most crucial part. Then when you back test your strategy, which I actually have done like over 300 back tests to figure out what works, you need to figure out a system that beats this percentage. So if you tell me that your risk to reward ratio is 2 to 1 and your win percentage is 33%, that is not going to help you because you're actually just not going to make any money. Okay, so let me do a more extreme example. Okay, so let's say I'm going to use a very, very insane risk to reward ratio, so 1,000. And here I'm going to lose $1. Okay, so you can think about how often will the market move $1 against me, and how often will it move $1,000. So obviously, in order for the market to move $1,000 is not very likely. So the win percentage is going to be incredibly low, and if for the market to move $1 against me, that is incredibly high. So then the break-even percentage is going to be 1 divided by 1,001. And then here, I'll have 1,000 divided by 1. Sorry, 1 second. I have 1,000 divided by 1,001. So this is actually the formula for you to figure out what the break-even probability is. So that means I actually need to expand this to a couple more decimal places. That means in order for me to make this a profitable game, I need to have a win percentage of more than 0.1% for this game in order for me to break even. And if you have no strategy or use a random strategy, then you need to figure out whether you will actually achieve this or achieve a win percentage that is higher than this. And in this case, you're going to see a risk to reward ratio that is very, very favorable, but it actually doesn't help you make any money. So that covers number 1 and number 2. So hopefully that is straightforward, because most people, when they're talking about investing, they either kind of look at the risk to reward without looking at probability, and some people just look at probability without looking at risk to reward. So I guess, if you look at the flip side of this, right, and you wonder why there's so much scam in the stock market, is because if I make the loss really, really big and the gain very, very little, then suddenly I can actually create a very high win percentage and still don't make any money. And I'm just going to demonstrate right here. See, if I win $1 every time I trade, I'm going to have a horrible risk to reward ratio, which is like almost 0. And then my loss is huge. It might just wipe out my account. My win percentage is 99.9%. And my loss percentage is 0.1%. So, and then I advertise to you saying that my system works 99.9% of the time, but it breaks even. So that's why I think, people feel like there's a lot of scam in the market when it comes to investing, is because they look at part of the equation without looking at the full picture. Okay? So that is probably the most important thing. Now, when you're backtesting, and you need to backtest, you need to test your strategy before you invest, unless you learn from someone who has done it before and have tested the strategy themselves, kind of proven the strategy out for you. When you are testing, right, whether you want to be a day trader or you want to be a long-term investor, but looking at the way you're asking this question, chances are you are investing in Forex or some sort of shorter term investing strategy. So when you are looking at risk to reward ratio, you need to include the transaction cost. And that is extremely important because when you're looking at the short-term market, it's actually very random. It's extremely random to the point where you will actually make zero gain if you keep trading continuously. Because right now, based on your question, you're saying randomly trading, right? And that means you can trade every single minute when the market is open. You can actually place a trade every single second, every single minute, every single hour when the market is opened, because that means you're not filtering and you're just buying and selling whenever the market is open, and you're going to place a buy and a sell order at the same time, and that means your trading frequency will go up. Now that obviously is a very extreme example. Nobody's going to trade the market every second of the day, and nobody's going to trade both direction, but I'm just trying to take your question to the extreme to demonstrate. So you're going to place a lot of trade. Now, if you are a short-term trader, you're probably going to place a lot of trade, maybe 1,000, maybe 2,000 a trade a year, and you're going to have transaction costs, okay? So let's say your transaction cost is $1 per trade, which is quite cheap in my opinion. And in this case, if you have a risk to reward ratio of 2 to 1, and then you're just breaking even. So if you don't do anything, if you have no transaction costs, you're going to break even. But by putting $1 of transaction costs in there, you're actually going to have a net loss of 66 cents every time you trade. So that means if your account, or if you're placing 1,000 trade for the year, you're going to lose $660. And here's an interesting story. So 5-6 years ago, I tested a lot of strategies before I ended up on the strategy I'm investing right now. So the strategy I have right now is called long-term investing using stock options, and you can actually learn more about it on my website. But before I arrived at this strategy, I actually, was testing a lot of strategies out. Whatever I can find on the internet, I probably tested it. And I was learning how to code, and I coded this strategy. And this strategy is perfectly break even. That means I place 10 trades, I place 100 trades. I actually have exactly 50% gain and 50% loss, and yeah. So after placing 100 trades, I actually lost money. So why is that? Because every time I place a trade, there's a transaction cost of $1. And after 100 trades, that was, the entirety of my account. It was $100, and then the transaction cost was approximately 1%, and then that essentially took out my entire account. That means if your transaction cost is 1% and you place 100 trades, you need to actually make 100% from the market. So when you think about it, the more you trade, the less you make. And you need to take you got to take into transaction costs into this equation here that I showed you in number 2. So finally, I just want to leave you with an important consideration. And that is really, what is your competitive advantage in the market? When you're looking at the market, there are some really smart people there. There are people with 40 years of experience. There are people that uses algorithms and supercomputers to trade the market. So you as an investor, what's your competitive advantage? And if you don't have a competitive advantage, then I think you need to learn from somebody who does. You need to learn, you need to do some research, you need to do some testing until you have a competitive advantage, until you know what your competitive advantage is, until you think you know that you're ahead of certain groups of investors, until you believe that you are somehow better positioned, getting in at a better price than other investors, you will have a very hard time making a profit in the market. And that's really what I learned from years of testing, trial and error, and studying and so on. So that's pretty much it for this video. And if you like this video, please give me an upvote. You can subscribe to my YouTube channel. I'm rapidly trying to grow my YouTube channel right now. And if you want to learn more, you can always visit my website. And I do have a free webinar there and some free resources as well.